Okay, well, we have Fook Hien Yap, the senior investment strategist at Standard Chartered Bank, joining us right now to take some questions. Fook, thanks very much. Good to have you with us here. Momentum seems to be coming back into the market here after a few sideways, lethargic kind of trading sessions. So new highs on the Nifty eyed again. Do you think there is enough on the tank for the market to add on meaningful gains from here, or you think it'll tire out? New highs perhaps, but then things are looking not so certain. What's the sense?
Yeah, look, I mean, we just published our global market outlook where we actually pushed out our view of a U.S. recession. We used to think that it would happen in Q4 of this year, but the data has been stronger than expected. So we now think that it's likely to happen in Q1 of next year. I think the U.S. data, especially the consumers, actually has been stronger than expected. There's been delivering a better economic print than we expected. So we are kind of neutral on the global equities front. As you say, in the short term, there are a lot of indications. The S&P technically it's moved higher since it went through about the 4,200. We saw that the CFTC positioning was very, very bearish at extreme negatives. But a lot of the short covering has been done in the last few weeks, along with the S&P pushing through to 4,200. So we kind of take a neutral view now for global equities. We're neutral on the U.S. as well, given that we do think that the U.S. recession, while it is still likely, there are still indications that it will happen. We think the timing has actually been pushed out now from Q4 of this year into Q1 of next year. And our view really remains to be that in Asia, we think that is where the risk reward is better. That's where our preference is in terms of the further gains that is to come. So that would be including China and India as well.
So in Asia, which is where you believe the risk reward is far more attractive and is a fertile hunting ground, which would be the preferred markets? Japan has been doing well. Some of the sheen of China has come off late. India looks interesting over the long term, but rich valuations keep investors a bit wary. How would you play the Asian markets from here?
Well, we're actually saying to allocate broadly. We do not have a pecking order at this point of time, so we do like these markets equally within Asia. So that includes China, India, as well as Japan. So we would prefer to allocate broadly. There are a lot of reasons for each market that we do like it. And yeah, the preference in China and the concern has always been the geopolitical risk. But we think we can see some of that unwinding. But there's also policies announced about the semiconductor restrictions now, whether that's going to tighten any further. We'll see how that play out. But we saw some of the visits from your senior government leaders from the US into China. So we think that is helping to abate some of the geopolitical risk. I mean, India is very, very strong in terms of the domestic growth. We like the domestic focused industries and sectors within there. We think that's going to continue to drive India's market. And within Japan, I think what's most exciting is the potential improvement in the corporate governance led by initiatives from the Tokyo Stock Exchange, prompting the companies to improve their corporate governance. And we've seen share buybacks at record highs. Net foreign inflows have also been coming in very, very strongly, consecutively for more than 10 weeks. So we think that is a sign for Japan's market to potentially re-rate in terms of its valuation. But yeah, to answer your question, I mean, we are trying to advocate clients to diversify and to allocate broadly.
Hi, Fook. Good morning. Nigel on this side. Fook, the last time you joined us, you were telling us that you were expecting the Fed to maybe hike once more. And then towards the end of this year, we're expecting some rate cuts. Do you hold on to that view? Because the economic data that's coming out of the United States is baffling on the consumption side, on the new home sales as well. Where is the recession? And you'll have pushed that back. So what are you expecting in terms of Fed action from here on? Is the rate cut still on the cards towards the end of this year?
Thanks for picking that up. Our view now in terms of how we published in our global market outlook last Friday is that we do expect a pause, so the upper bound at 5.25% until the end of the year. July is going to be very live. We still have an inflation print coming up next month on the 17th before the FOMC meeting. So I think July is very live, but our expectation is that we're going to see inflation coming off in terms of the trend and that we expect a pause in terms of the Fed rate hike at 5.25% at the upper bound at the end of the year. We do see a cut happening towards the middle of next year. That's in line with our view that we could see a U.S. recession coming in the Q1 of next year. So we do see a cut happening by the middle of next year, 2024, bringing the rate down to 4.5%. And look, I mean, the signs, we started the year thinking that, U.S. recession would happen. We've seen your indications in terms of your manufacturing data, the consumer sentiment. We saw the bond yield inversion that's been historically a very strong predictor. But what's been holding up, I think, has been the U.S. consumers. The spending has just been stronger than expected. In terms of the pent-up savings from the pandemic, various estimates out there could be still about $1 trillion. So that's been really holding up the economy. And therefore, we think our view of a recession has been delayed from Q4 this year until Q1 of next year.
All right, Fook, it's good speaking with you as always. Thanks very much for joining us. And we look forward to our next chat. Thanks indeed. Well, we'll take a quick commercial break here. A list of top stocks to watch is lined up when we come back with our research team in just a bit from now. Stay with us.